And this is Vignesh from E&I department. Today I am going to take a seminar about the cost analysis. Cost analysis. Cost refer to the total expenditure in the production of the commodity. Analysis refer to the study of behavior of cost in relation of one or more production. A cost analysis also defined as a examining the cost of the production and the revenue or the income of the company at various conditions. And the relationship between the cost and the output can be expressed as a cost function, which is C is the cost and Q is the quantity of the output. Now we are going to see some cost concept. First, we can see the money cost. Money cost is expressed in the money term is known as a money cost, which is also known as available in the cash mode. Next, the real cost. A real cost is a reference to the payment referred to the efforts or sacrifice of all the owners that can be service in production. Next, the explicit cost. The explicit cost is nothing but purchase of the factors of the production. It's known as the explicit cost. The explicit cost is also known as a paid out cost, which can be the film or a production or company can be spend their cost for the salary of the workers, EB bill or any rental methods and transportation, fuel, vehicle engines, etc. Next, we can say the implicit cost. The implicit cost is nothing but is a use of the resource that can be film already wants. Is known as implicit cost. It is where the or organization or the company which buys their own land or own machineries for their commercial uses, is known as a, which they spend for that the own investment is known as a investment for business or a commercial uses, not the explicit cost. Economical cost is nothing but it is some summation of the implicit and explicit cost. We can get the total cost of how much they spend, how much they can be get. Next, we have floating cost. The floating cost is nothing but it's a credit. It can be cannot be business activity, cannot be asset criteria. Fixed cost. Fixed cost cannot be changes and the quantity of the output changes. The cost will be fixed if the output is of the quantity or the increases. Variable cost. A variable cost, it is a level of the output. It is can be changes in the period of the time. For example, it is wages of the temporary worker, cost of the raw material, fuel rate, and the EB bill. It is can be changed by the short period of time. Stuck cost is nothing but it is a past investment. They cannot be recovered in the future. For example, any company or any organization or investing in, for example, in or one particular machine which create a particular product, but they stopped the product in present case. They stopped the product, so they cannot use that machine which can be they were invested for the cost, so the cost invested in the machine can be struck in that moment. Next, we can go into the short run cost, and here we are going to see the total fixed cost. A total fixed cost is nothing but it is a fixed. Already we know the fixed cost, so the it can be fixed. We cannot be changed even the total output is changes. A total variable cost. A total variable cost is nothing but it is a variable cost, so it can be vary when the output unit can be varies. Here we give the output as a unit and the total variable cost is the rupees. If the total unit is increases, the output costs also increases. So we can see in the graph the if the output is increases, the output cost also increases. A total cost curve. A total cost, it means a sum of the total of all payment, which is called the cost of the production, which can be the addition of the total cost, total variable cost and total fixed cost. And average fixed cost. It is referred to the fixed cost per unit of output. It is obtained by dividing the total fixed cost divided by the Q. Q is nothing but the quantity. By dividing the total, here the fixed cost, the rupee cannot be changed. It is being fixed. By dividing by the Q, we can get the average fixed cost. Here we can see in the graph the when the quantity is increases, the y-axis, the average cost fixed cost will be decreases. Average variable cost. Average variable cost is nothing but already we know the what is variable cost. Variable cost is variable in the cost by increasing the quantity. Here by dividing by the quantity we can get the average variable cost. Here we can see in the graph the when the quantity is increases is decreasing, and at some point again it can be increases. Average total cost. Average total cost is nothing but is the cost per unit of the output. It can be obtained by the two-way by dividing the frame by the quantity. Average total cost is equal to total cost divided by quantity is one method we can get the total average total cost. And average total cost had to be divided on the another method by using the adding the total average total cost to average fixed cost and average variable cost. We can obtain the average total cost. Now we are going to see the marginal cost. Marginal cost is nothing but it is the last single unit produced. It is defined as a change in the total cost resulting. See in the table, the when the marginal cost is depend upon the previous total cost. The previous total cost. A present total cost is minused by the previous total cost. Case here, 1200 is a present total cost. By minusing the 1000 from the previous total, we can get the 200. The 200 is known as a marginal total cost. Final, the long run cost curve. In this long run cost curve, all the factors of production become variable, and exceeding size of the variable can be increased in the cost of case of the long run. There is either fixed or nor the fixed cost, but the long run average cost is a cost divided by the level of the output. Thank you.